As I mentioned, that U.S. personal consumption expenditure index matching expectations, and at least some observers think this opens the door for a rate cut next month from the Federal Reserve. Let's get more from Bob Elliott, CEO and Chief Investment Officer at Unlimited. Bob, thanks very much indeed for joining us.
Thanks for having me.
What do you think? I know it's always hard to get inside Jay Powell's head, but do you think the door is open for a rate reduction?
Well, I think from the Fed's perspective, they made it clear at Jackson Hole that there was another shift in their reaction function, and this time largely ignoring any inflationary pressures that exist in the economy, and instead laser focused on that labor market and that part of their mandate. And so, the real test is going to be what we see next week with the employment report and whether that continues to show weakness. Certainly, some folks on the Fed, Waller in particular, has indicated that there actually might be some further weakening of labor markets in that data based upon timely information. And so I think that's basically what's going to solidify the probability of a cut in September is what we see next week.
And just remind us, the labor market in the States has shown decisive signs of weakening?
Well, I think the challenge with looking at the U.S. labor markets is the significant policy-driven constraint and supply has meant that we've had a weakening of demand for labor, but it's also been met with a weakening amount of supply. And those two things together have actually meant that the unemployment rate, which is the Fed's preferred measure, has remained relatively stable. Now, I think part of what's happening on the committee is a push to move away from tightness as a focus, as evidenced by the unemployment rate, and instead focus on top-line employment numbers like payroll growth or employed numbers from the household survey, both of which are very weak in any sort of historical context. And if the Fed is focused on those numbers, it's unambiguous that the labor market and income growth has slowed in the U.S. over the course of the last 6 months. It's just that the tightness in the labor market hasn't really shifted much.
We saw U.S. President Donald Trump, as is his wont, creating drama at the Bureau of Labor Statistics, firing the boss, saying that she was not a valid custodian of the numbers. Will that damage the credibility of jobs reports?
Well, I think any sensible macro investor is turning to triangulations outside of government reported numbers these days to at least either confirm or raise questions about what happens in the publicly reported numbers. Now, when you look at the publicly reported numbers, there is a methodology, a printed methodology that the statistics agencies are supposed to adhere to in their method of collection. And most likely we would start to hear some noise if those methods were moved away from, particularly due to political influence. But for now, really it's about triangulating with, other data that's coming from the private sector. So things like ADP, which gives a pretty good sampling of the U.S. labor market and is a good triangulation point for what the government reported numbers are.
We often hear ad nauseum that America is a consumer-driven economy. Tell us what's been happening with household consumption.
Well, it's been pretty modest. If we look at the first 2 quarters of the year, even with a slight revision upwards in yesterday's GDP report second revision, household demand has fallen from running at about 2 to 3% real to running about 1 to 1.5% real in the first half of the year. And today's data largely aligns with that basic picture. And so you basically see a story where, the U.S. consumer is really starting to pull back in the first half of the year. I think part of that is, broader concerns about overall income growth and labor market indications, not to mention the fact that the sort of core asset that households hold in the U.S., which is, housing, we're starting to see some relatively sharp weakening in that area as well. And so, the picture is not looking great for households, and it's showing up in reduced consumption.
What strategy do you think investors should be adopting now? For example, should they be market weight in those famous Mag 7 stocks?
I think there's certainly a lot of hope built into the pricing of those Mag 7 stocks, but probably even more concerning is the hope that's built into the 493, where expectations are for a rapid rise in earnings growth across sectors beyond the Mag 7, essentially betting that the overall economy will remain strong and that AI benefits will seep into the rest of those companies relatively quickly. And when you look at where earnings power is really coming from, the real economy, meaning outside of sort of the AI names and financials in the U.S., has been growing quite weakly. And we're really not seeing that. And there's really no indication that we're seeing a reacceleration in the U.S. economy here in the recent data. And so you add that up, and what I'd say is being cautious on the 493 is probably even more warranted than being cautious on the Mag 7.
The 493, all the other guys. Yeah, those poor old other guys. What do you think? Will we see an economic revolution because of AI? I mean, it's going to change the workplace anyway.
Well, I think there's a real question about how impactful AI will be, and in particular, probably over a time frame that anyone cares about as an investor, how impactful it is, relative to all the investment that's going on there. When you look at the actual productivity data in the U.S., it's notable that we essentially have seen no improvement in productivity numbers as a result of the large language models or AI or automation in the last couple of years. U.S. productivity is on the trend predicted back in 2018 and 2019 by the CBO. And so what that suggests is whatever's happening with AI, it's mostly an investment story right now, and mostly what I describe as a consumer surplus story, meaning people are getting benefits, but they're not actually translating that into increasing their economic activity. And so that really raises questions about whether the massive boom in CapEx is going to be able to persist when, even the hyperscalers aren't really seeing the cash flow benefits needed in order to make sense of the magnitude of investment that they're doing right now.
We're tight for time, but just tell us a bit about your ETFs. What's the biggest ETF product that you're offering right now that you're seeing big inflows into?
Yeah, I mean, we bring hedge fund strategies to every investor through our ETF products, leveraging proprietary technology that allows us to understand how hedge funds are positioned in real time. And what we're really seeing is a lot of interest in our macro strategy, where, if anything, this is a macro moment across a lot of different ways. And macro managers have done a great job navigating the environment over the course of the year. And so a lot of folks finding that compelling and diversifying to their traditional assets.
We will have to leave it there. Thank you very much, Bob.
Thanks for having me.
Bob Elliott, CEO and Chief Investment Officer at Unlimited.